everyone. Welcome to the third episode of BRS Industry Round Up series. For today's session, by popular demand, we have with us Mr. Jonathan Allers, the Chief Executive Officer and the Managing Director of Hatton National Bank PLC, to discuss the current macroeconomic developments concerning the banking industry. Sir, it is our pleasure to have you with us today.
Pleasure to be
So,
with you.
To start off, post IMF board approval, there's a lot of uncertainty and ambiguity over how debt restructuring will pan out and what kind of implication that could have on the banking sector. So, if we start with the external debt, Mr. Alice, would you be able to share what kind of a haircut are you expecting on ISBs in your base case scenario? And do you think there would be any changes in the CBSL's treatment of settling SLDBs in rupees?
So the short answer should be my expectation is a zero haircut on ISB, and on SLDBs I expect the current modus operandi to continue, which is uh, the government has been and the treasury has been paying us in either rolling over the SLDB if the banks have been comfortable, or they have been given bonds whenever possible that they have been given rupees. So with the exception of the last bond and maybe the one that matured yesterday, all others have been settled according to what was planned, and we have been told that even the previous bond should get settled by about the middle of May, and we look forward to that. So why am I saying that my expectation is a zero haircut on ISBs? I mean, obviously here when you talk of possibilities, Heshan, whether you talk of different instruments, you're looking at, a capital haircut or interest coupon changes, or, extending the maturity profiles of these instruments. So unlike basically other investors who put in money into ISBs as an investment and obviously fully evaluating the risk. The likes of banks, what they did was they put money into ISBs as part of their liquid asset ratio, right? So what you need to know is the contra entry of that is client deposits and foreign currency deposits, and any treatment of ISBs is detrimental to depositors' confidence, and I'm sure the likes of government and the central banks are fully conscious of this fact.
Understood, Mr. Aras. So, if we move on to domestic debt, most of the investors and the general public are keen on understanding the implication of domestic debt restructuring. So, CBSL's investor presentation on debt treatment emphasize that the voluntary debt optimization is encouraged for treasury bonds. So, Mr. Aras, would you be able to explain what does it mean and what are the scenarios that could play out and its implication for the banking sector?
So we heard the governor state a few weeks back in terms of that treasury bills will not be reprofiled, and only the treasury bills held by central bank, if at all, will get reprofiled. So that's one instrument that has been cleared. Now, in terms of treasury bonds, there was a concern, and that too. A couple of weeks back, you had the governor mentioning that it won't be DDR, but it will be DDO, which is an optimization, which is a voluntary, discussions that will be held with certain categories of bond holders. And I believe some of those discussions are ongoing, and depending on the investor appetite, the appetite of some of these bondholders, their expected return parameters, if they happen to be, pension funds or the likes, some kind of arrangements could be made. But here again, what we understand at this moment, although it's not fully clear whether it will end up being DDO, or if the DDO initiative is not totally satisfactory, would it then kind of move to a kind of DDR? Is some speculation that's going on. We hope that that would not be the case. We need to look at basically divesting things of less interest to us. We need to sort of let go of what is not material. I think the whole philosophy, I have seen it read it very clearly in the IMF statement. It's the same with HNB as well. Is less is more. Handle less, and whatever you're handling, that little bit, do it properly and make it impactful, rather than spreading your tentacles too wide and mismanaging everything and being unproductive and inefficient and putting everybody else in trouble. So I think the time is right to look at divestment as a very important initiative. Make sure that some of these anti-corruption legislations, etc., come in place. Better procurement, better cost management, get rid of unproductivity, improve governance, and make this a better country and a better place to do business with and work with, and then look at other ways of bringing in money, like purely based on credibility. Make this a business place where foreigners will come and do business, where FDI comes through. And I think those are the things that, if you really were looking at it positively, that you would try to do.
Correct, Mr. Alas. So, moving on, considering different deputy structure in scenarios, how comfortable are you in terms of capital requirements post deputy structuring?
So, firstly, I suppose to answer that, Hishan, it would all depend on the extent of that restructuring. I answered your first question by saying I'm at a position where I think, ours is depositors' money is placed in liquid asset ratio, so we don't see any requirement for any haircuts or reprofiling, and that we should be treated differently. Albeit, I'm fully aware of the agreements that everybody has signed, etc. There is a lot of conversation saying that international creditors are putting pressure, in order to say that even local creditors on the local bonds must take a equal share, actually to take meaningful steps and actions to make sure that that happens. And in case there is a slight hit or some flexibility that we might have to sort of give in, I think there has got to be banking sector stability funds, the likes of IMF, World Bank, ADB, needs to actually come through to make sure that that some kind of support infrastructure is in place, because this is not the time at this kind of pricing to call in investors and put pressure on our investors who have already been hit over the last so many years, post Easter Sunday, COVID. Then we had social unrest, political unrest, and the economy has just not moved. And with recording negative GDP, it's not the best time to be calling on our investors to be putting in equity. So from that point of view, I mean, we would need some kind of support funding that needs to be in place in case there has got to be some kind of treatment, which we think should not be, the only thing that should be looked at. Like I said, revenue streams, divestment, small government, less is more, reduce costs. All these are important initiatives that needs to be looked at the same time.
Thank you very much, Mr. Alas, for that comprehensive answer. So, moving on with the positive sentiment post IMF board approval, especially towards exchange rate movement. How are the current foreign inflows and outflows dynamics, and what are your views on the exchange rate movement for the rest of the year?
Good question, actually. Now, post IMF, and then you've also heard the World Bank saying that they would give in a $1.5 billion over 2 years. ADB will come and support. All these are really, it's good news for us. And that has sent positive vibes. And you have seen the exchange rate, which actually depreciated in a very exaggerated fashion, has now, kind of been brought back. And the future trajectory of the exchange rate again depends a lot on our behavior. So if we continue this momentum, if we continue to do all the right things, like I spoke of governance, I spoke of, good fiscal management, discipline, cost management, and we show that, we are ready to come out of this, take the pain now in order for, sustain future, progress for our people. Lot of people from outside will also come and support us. So the foreign inflows should be stronger than the outflows. So from that point of view, we have seen tourism picking up, and we should not use. We may be having many issues in this country, but we should not, do things to stop business, to stop tourism, to stop all the good things happening in the country. Yeah, in order, we have lost billions on account of loss. We continue to promote all those avenues that bring in the inflows. Remittances must be encouraged. Tourism must be encouraged. Exports, we must continue to drive them. Could be challenges, but we must not let go. We must really try and push the needle on exports. We must promote entrepreneurship in the country. Lots of new manufacturing, import substitutions to reduce the import bill. All these are important. At the same time, as much as it's difficult for me to say, the existing import controls must continue also for a while. I started by saying we need to tighten our belts. We don't need some of these luxuries. We need to manage with just the essentials for the next maybe a couple of years till we get out of this. And here it's a long term thing. It's not as if things will be rosy in the next 2 to 3 years. We need to be ready for a fairly long term hard grind to get out of this. So discipline is key. We can't think, okay, we got a little bit of money from IMF, now we are out of the woods. Far from it. This is just the tip of the iceberg. There's a long, long way to go, and we need to sort of endure. We need to, endurance is key. Sustainable initiatives is key, and we must, make sure that we do everything that gives confidence to people to come and do business in Sri Lanka, so that foreign direct investments will flow in, and all these will contribute to our foreign reserves, and not just only having to look at the main foreign revenue sources as well as borrowing. Let's try to actually make this an attractive place where people want to come and visit us, people want to come and do business, people want to put their money and get good returns because there's good business that is taking place here. So my response to you is the direction of the exchange rate would depend totally on how we manage ourselves, discipline ourselves, and have the right strategies in place to drive inflows, manage outflows, and make sure we start building up our reserves and not get into the same predicament that we fell into in the last few years.
Thank you very much, Mr. Alice. So, as you have already pointed out, given the extremely challenging economic conditions and also higher interest rates, can you shed some light on the credit growth and asset quality and the deposit growth for HNB in the near term?
So on credit, I mean, it could be HNB, it could be in general terms for the industry itself. Credit growth is something that we need to be careful, Heshan, in terms of the current interest rates are too high. We may probably try and understand why that is the case on account of the very high inflation, which is now slowly coming down. We saw a drastic drop from the 50s to the 30s in the last reported numbers, which augurs very well. we are all looking forward, to probably single digits by the end of the year. I mean, but still, I mean, things are expensive in Sri Lanka. We need to know that, it requires a fair amount of money. On top of that, interest rates will slowly come down. Exchange rate, though it has come down, it's still at a elevated level, double from, not some time so longer ago. So in general, cost of living is high. People are finding it difficult, and then on top of that, with these high tax rates, which may be a necessary evil in the short term, is something that will make uh, investment probably a question mark, a negative for most people. Will be very apprehensive, think very carefully before making further investments. In addition, existing debt itself would be a challenge to repay. So we need to be very careful of impairments. A lot of build up has been done over the last 2 3 years as moratoriums have been we have seen moratoriums for the last 2 3 years. We have built management overlays to kind of support it. But now that moratoriums are over, we are seeing that not all industries and not all customers are ready to, commence business. And in that regard, some are still needing a little more time, and these require further treatment, further impairments, and we need to be careful. So, based on the current inflation, the higher taxes, as well as high interest rates, and the risks that are inherent in this environment, I would think, credit growth would be somewhat flat this year. And the more important thing would be how do we actually support business revival and help our customers to get back on their feet, and then ensure a reasonable amount of recoveries is done and that impairments are curtailed. Deposits continue to grow because the rates are high. Obviously, treasury bills are competing with those high FD rates because treasury bills are at a very high rate at the moment. And the impact that we have felt mostly is on our CASA balances because of the high interest rates. We have seen CASA balances move and FD balances increase, and that overall has led to a weighted average cost of funds increase, which doesn't allow us then to place our funds, to lend our funds at very affordable rates to our customers, which is important. It's important because they need low rates to do good business as well as to be able to repay.
Understood, Mr. Alas. Thank you very much. So that brings us to the end of the third episode of BRS Industry Roundup series. On behalf of BRS and our clients, I would like to thank Mr. Alas for allocating your precious time and sharing your insightful information. Thank you very much, sir.
Thanks for having me. Thank you.
Thank you, Mr. Alas. Thank you very much again.